All right, let's move on from that one now. A day after ICICI raised rates by 75 basis points for the second time in just a month, the bank is strategizing to deal with the impact of the rising interest rate scenario, which of course is likely to hit the bank's retail lending business quite significantly. Now, ICICI's top management has gone into firefighting mode to try and limit rising defaults and also clean up the bank's international operations, which were dented by the global credit crunch. Ira Dugal has more.
It started as a corporate lender and transformed itself into a retail powerhouse. But now ICICI's retail dream is starting to look shaky. Having raised its benchmark rate by another 75 basis points to 14.25%, the bank's customers have now seen a nearly 2% increase in borrowing rates this year. And the bank's management warns that things could get worse.
The economy will go through some temporary pain, and the pain, that I'm talking about is this, that, interest rates definitely, therefore, we are not going to see them coming down for some time. We're going to see them moving northwards.
The pain is being felt by customers, but it's also reflecting on the bank's balance sheet. Rising rates and rising defaults have already forced ICICI to exit segments like small-ticket personal loans and consumer durables. Even the segments that they remain in, like home loans and auto loans, ICICI is tightening lending standards to keep defaults under check, which in turn is choking off growth.
As interest rates go up, you can afford lesser and lesser value of loans because your your interest servicing impact is higher. So that has resulted in, the rates of growth in this business coming down from, the peaks that we saw of 35–40% per annum to what I think the growth rates this year are going to be are between 5 and 10% per annum.
While ICICI tries to protect its domestic balance sheet, the bank is also being forced to clean up its international operations. ICICI, which took a $264 million loss on its overseas credit derivative portfolio, is now in the process of winding down that $2.2 billion portfolio to avoid further losses.
As I said, not only have we not increased the portfolio, we have actually wound down quite a bit of that portfolio. So, as we speak today, more than 2/3 of that CDO-CLN portfolio is in fact wound down from our balance sheet. So it no longer exists in the balance sheet.
As ICICI's management gets into defensive mode to ensure that a slowing economy and rising rates don't hurt their balance sheets any further, the bank is now focusing back on corporate lending to try and revive growth. ICICI hopes the $600 billion investment pipeline for corporate India will withstand the economic turmoil and in turn help banks get through these tough times. In Mumbai, Ira Dugal for NDTV.